Hey, greetings, everyone, and welcome back to the Royce Report. I've got my good friend, Edwin Arocho, back on with us. Good afternoon, Edwin. How are you?
Hey, Todd, I'm doing great. Excited to be here for round two with you and see if we could be a continued resource of information to some people here. So
it's some unique times, and we're here to bring you Navigating the Residential Mortgage Maids Part 2. And before we go any further, please, if this is your first time here, please hit subscribe, as we're working diligently to bring you information from the front line of people who are working with the consumers every single day. So, Edwin, let's kind of start on the refinance market if we can. When this pandemic hit somewhere around the second week of March, the lenders offered everyone forbearances, or really floated the idea of mortgage forbearances. And many people took them because they were scared of not being able to make their mortgage. Were they going to have a job, not have a job? So why don't you just bring us into, kind of bring us up to date on that, and give us, kind of close the loop a little bit and provide the viewing public with some great information.
Sure. I think it starts with the forbearance agreement, and that word forbearance was really birthed from the stimulus package that the government created to attempt to bail as many Americans out of the situation. You know, unemployment was high. People were dying at an extremely high rate. Companies were closing. Restaurants were closing. Businesses were closing. And America needed a safety net, right? So the safety net at the time, everybody assumed, was this forbearance agreement, right? And this forbearance agreement simply allotted an individual who owns a home to show they were suffering some type of a hardship through COVID-19 or some trickle-down issue associated with COVID-19, and were allotted an opportunity to technically postpone their mortgage payments, right? And there wasn't a lot of clarity in regards to postponing. Like, do they postpone and add it to the back of my loan? Do they postpone and forgive it? So there's a lot of confusion about a month ago to 45 days ago in regards to that. But we found right now that most of the forbearance agreements, the ones that are executed properly by the fairly larger lenders, was to give you access to not have to pay, or the ability to not have to pay your mortgage payments for 3 months. And then once that 3 months was over, then you would have that total 3-month charge due up front. Other lenders offered their homeowners an opportunity to do that for an extended amount of time, up to 6 months. And what that was causing, or what that caused, was investors don't really run businesses like each other. Not one investor on Wall Street, not one bank is built the same. So
when you say investors, let me just quickly jump in. So when you say investors, when someone applies for a mortgage through one of the companies like ours, like Mortgage Unlimited, we basically broker the loan. We fulfill all the obligations, though a bank or some other large lending institution purchases that fairly quickly. So that's what we mean by an investor, correct? And again, I didn't mean to interrupt, but a lot of borrowers are a little, because they don't borrow all the time, or just a little green or naive on that definition.
Yeah, sure. So us as private mortgage bankers, we have relationships with larger funds or larger companies or larger banks. Those other banks that we have relationships with, we call investors, because we will satisfy specific needs or around a specific mortgage. Then we will bundle that opportunity or that mortgage into a security that we sell to a wholesale lender. So it's pretty much like we're buying the food, we're wrapping it up, and then we're distributing it to someone who could sell it wholesale, right? So that's kind of the same concept with lending. And what happens is, when we sell to these investors or other banks that are larger entities on Wall Street, they have servicing rights, and that's where you get affected, right? This forbearance message came from the company that was servicing and retaining your funds or your payments. Mm-hmm. And they were saying, hey, tough time, here's 3 to 6 months, caveat, you owe us the bulk in 3 to 6 months. The issue with that is, if you don't have it today, the likelihood of you having it tomorrow is even smaller, especially with this pandemic and the unknown looming through us like a dark cloud every single day. So what some people were doing was saying, I'm getting ahead of this. I have tons of equity in my home right now, right? 34% of Americans are sitting on 50% equity or better. And they said, I'm going to refinance. And unfortunately, when they went to refinance, there's a forbearance agreement that's holding them from taking the opportunity to access those funds so they can pretty much wait this out, right? Wait this pandemic out. So that was the situation. And we did get some color in the last couple of days today in regards to the forbearance agreement and how banking is going to allow some flexibility around forbearance agreements to give these individuals hope and be able to give them access to the equity that they currently don't have access to right now.
And what was, in broad brush, what was that color, as using your word, or clarity that we obtained over the last 24, 48 hours?
Yeah. So what some investors are doing right now on the basis of what are called government-sponsored enterprises, Fannie Mae and Freddie Mac, are realizing, oops, we didn't really check off all the all the necessary boxes when we made this huge
frequent
move.
Problem.
Yeah, right. We fixed one problem and created another one. So what they're doing right now is saying, listen, if you're in a forbearance agreement and you have the means to get out of the forbearance agreement, great, get out of it. And once you've caught up with the 3 months payment that you agreed to go into, or the 6 months payment you agreed to go into, and have leveraged a document to show that the forbearance is now released from your credit, then you become eligible to refinance. So we're going to see a large influx of refinance opportunities coming down the pike, September, October, November of this year, which will actually inject some life back into Todd, and I'd like to hear your feedback on this, into the economy, right? Like if we have no access to income, we have no access to funds that we built in equity. I mean, what does the economy look like going into 2021?
Well, the economy is regressing, and people like to say it's a recession. By the time the officials tell everyone it's a recession, the people on the front line already know it's a recession. So the equity that they can pull out is going to do a couple things. Number one, it could be emergency capital because, the incomes could be erratic, and one person may be able to support the mortgage, because if it's emergency capital, they're really not going to be able to pull it out anyway. But as the economy starts to slowly churn and people start going back to have that extra money, that may be their child's college payment, that may be a small renovation. And not only that, but with the interest rates being this low, it may not even be pulling money out. They may go from a 4.5% mortgage to a 3% or a 3.25%, or even if they have an old 5% mortgage, they may be able to pull a point to a 1.5 out of that interest rate, and that enhances their cash flow and eases the financial stress that many people are now involved with.
Yeah, I love that, and I can see that, right? Because right now people are struggling, and the opportunity to manage debt efficiently is right in front of our faces, right in front of your faces and our faces if you're a homeowner, because this is the tool that you could use to technically get yourself out of a pickle, right? And most of America is currently in this pickle, and we need a way out of the jar. And it's up to our government and institutions to kind of help us figure out a way to get out of it without creating additional issues for us in the near future. So that's where we are today.
Yeah, and I do believe a lot of opportunities are going to open in the fall, like you said, September, October, November, as the forbearances start to come to an end. Things start to open. Unemployment is very high here in New Jersey, where we're both located. Though it did also, that is one side of the coin. The other side of the coin is they're getting ready in the next couple of weeks to really start opening the economy. I read where gyms, salons are going to be able to open, and that's a great boost to a lot of people. They'll be able to get rid of their stress in the gyms, be able to get a haircut, because some of us need a haircut. Yeah, me too. I think I'm an inch shy of a ponytail there. So,
I'm trying to grow my ponytail out here. Get that.
So, but also to get people to feel good about themselves.
Right.
Even if you're, for the salon, even if it's half capacity is always better than no capacity. So I do believe we will slowly start seeing an uptick come the next 30, 60, 90 days. I think it's going to be slow, but I think it's all doable.
Yep, 100%. When people get back to work, they're going to feel a little bit more energized. They're going to feel, I think this is going to create an opportunity for people to be more productive in a shorter amount of time, so they can, spend more time with the kids or read that book or go outside. So I think it's we're resilient, America, right? So it's going to be great to watch. And the other thing is everybody's worried about where rates are going to be. Rates are low.
Oh,
they're
very
going to
low.
stay low.
Very low.
They're going to stay low, everyone. So yeah, there's an opportunity, and you want to take advantage of an opportunity to help your family or get that renovation done or consolidate those consumer debts or do it. Like don't hesitate. Don't wait for the sky to be bluer or the sun to be shinier. If it makes sense, don't wait. Just get it done. Right?
You're absolutely right. Someone told me once, if you always waited for the stars to line up, you'd never do anything because you have to make them line up sometime. With that said, and we only have a few minutes left, so maybe you can give just a quick scenario. I'll flip the video over to you on how to analyze whether a refinance is good for you or not, or how we analyze whether it's good for you. And then everyone else has to pretty much do their own analyzation. So I'm going to get this flipped over to you and see if we can bring your screen up here. It's all yours, Edwin.
Okay, so let's see if we can do this.
So if we can bring up a quick refi screen. If not, those things happen. We're in the money business.
So here we are. I'm just going to push this over here. The premise of an analysis right now during this time is that, for the most part, most mortgages are shopped for with rate, right? But right now, a lot of America is coming to a realization that shopping for a rate in a mortgage, like shopping for a rate for a car or credit card, are two totally different things, right? The mortgage is a financial vehicle that would allow you to manage debt as efficiently as possible while you're building wealth to your commodity. Your commodity is your house, not the financial tool, the mortgage, right? The mortgage would yield you a specific rate because you're interested in a specific payment so you could manage your debt more efficiently. But in order to make the best educated decision, there's a couple of things that you have to keep in mind. And one of those things is identifying exactly where you currently are, right? And then second, identifying where you want to be in a short pocket of time. Do you want to make an impact on your monthly payment today? You want to make an impact on your monthly payment on interest over time. And so what we do when we're dealing with, I want to pull up Todd, do you want to do a refinance for look at it from a refinance standpoint or from a home buyer standpoint?
I think the refinance, since that's pretty much what we've covered today, and I just believe that would be some great information for the viewing public.
Great. So I'm going to pull in a refinance opportunity for an individual that just applied today, and we've been going back and forth in conversation for about a week. So people aren't making decisions in 7 hours anymore, right? And you shouldn't be. You should really be looking at things short term and long term. So here's a scenario. Guys, am I sharing my screen with you? Or?
You should be able to, yeah.
I believe I am, but right now I will. All right. So am I sharing my screen?
It's not popping up, no.
Let's see. Okay, I figured it out.
All right.
I have too many screens up, guys, so I'm sorry.
That's all right.
So right now we have an individual who is currently at 2.875. He has a fairly high interest rate, And what we wanted to do was discuss an opportunity where I can impact him immediately. He was looking for cash, right? So his immediate impact on a potential refinance today would be $250 or $247 monthly savings. Now, before we got to that number, we needed to confirm if that was the number that he was looking for. He was actually looking to save $200 a month. So it's the opportunity for him to save $250 is there. Then he wanted to know in the next 7 years before he moves, how much forced place interest, right, or principal savings that he create for himself over the next 7 years. We're saving him $18,000 in the next 7 years, and then the term is for approximately 15 years. So he's currently in a 27-year term, and he's going back to a 30 to allow him the opportunity to free up $250 in cash flow monthly and $18,000 over the span that he has left to stay in the house. Understanding that in 15 years, it doesn't matter. He's not going to be in his house for 15 years. So that hey, what do I pay at the term? The term doesn't matter because what you care about is the term that you're going to be in the house for before you sell. So we just go into a deep dive analysis of where you currently are and where do you want to be today? Where do you want to be in 7 to 5 years, which is the average time that an individual has to actually live in a property, or the time that elapses before they decide to sell, or if you are truly writing out, the house of your dream scenario, then we look at that as well. So it's very important to analyze in detail everything from your payment breakdown to your closing costs to, immediate, short, and long-term savings. And if you're not doing this in this manner, you're providing yourself a disservice.
Right, and this is great, and we're pretty much running out of time. One thing you didn't bring up, and we'll be able to discuss it the next time, is you're saving them $8,000. Simultaneously, over that time frame, their equity's going up. So
Correct.
You're not only saving them $18,000 in real money,
Correct.
but the equity growth. So it could actually be 18 plus 12, 18 plus 10. So this is a great program. I love it. I use it frequently. So Edwin, if you could just flip that screen back quick.
Yeah, I'll flip it back to you.
There we go. As always, Edwin, I just want to thank you for your time. I really appreciate it. The information that we provided the last time, quite a few people logged on. There were some great comments, and I hope that you'll come back for part 3.
Yeah, absolutely. I enjoy our conversations and attempted to be a resource here of information for your viewers.
Oh, thank you again. And again, everybody, including you, Edwin, I never want to leave you out. As always, be well, be safe, be happy, be successful, and always prepare to win. Please hit subscribe. Come back. Everyone have a great holiday weekend. And Edwin, thank you so much, and the best always to you and your family.
Thank you, Todd. Have a great one.
Thank you.